Hello and welcome, and thank you for attending this webinar. This webinar is centred around the so-called war on landlords. Not my phrase, it was coined by the media last year when the tax changes for the property sector were announced. So if we can just make a start on that. I want to give you a brief agenda, let you know what we're going to be discussing tonight. We're going to be talking about the recent tax changes which affect landlords and property professionals. Relatively brief on that one. I want to concentrate on the stamp duty increases and the mortgage interest relief changes, namely because those are the two that are the most visible and the ones that will have the most impact, I believe. So we'll be doing that, and then finally we'll be talking about what can be done to help mitigate these. I'd like to mention I'm not an accountant, and although I've sought financial advice, I'm presenting this from the viewpoint of a property professional, and it is extremely important that before making any large decisions regarding you or your clients' portfolios, you need to seek the advice of an accountant to make those decisions. If I can give you a brief bit of information about myself, my name is Chris Nelson. That's me in the bottom right. In 2004, I qualified as an energy assessor and HIP provider. Took a career change from IT to qualify as that, and I founded Nelson Home Inspections, which was a company basically to provide EPCs and HIPs to estate agents and letting agents in the Coventry and Nuneaton areas. In 2005, my property investment journey began. Essentially, it was through talking with my estate agent clients and letting agents, and I could actually see what a good vehicle property was, obviously for retirement, for income. As we all know, it's a very good investment vehicle to go with. Took a little bit of a hit in 2010, 2011. The HIPs were scrapped by the coalition government. So while I went to lick my wounds, I went back to work part-time in IT while building the property business and trying to get my income back up so that I could concentrate back on the property side of things. That culminated in 2014 when I founded and incorporated Nelson Home Investments Limited, which was inspired by the release of the repossession figures over the 10 years previous. The repossession figures were quite shocking at the time, and it seemed that people were caught between the devil and the deep blue sea when they're in that repossession situation because of the sale and rent back regulations. So Nelson Home Investments essentially offered a solution to that, and that went down very well. And then the latest release of those figures have shown that the repossession figures have improved a lot, which has allowed us to concentrate on the war on landlords and to find ways to mitigate the effects of that. Before we actually go into the details, I'd just like to bring your attention to a couple of news stories to show that this has hit the media and it is happening. The first one is from the Sunday Express on the 5th of March. The article doesn't really say a huge amount more than the headline does, but the new law which they're talking about there is Section 24 of the Finance Act 2015, otherwise known as the Mortgage Interest Relief Law. So if we can go from that, the next one is possibly a little bit more informed, and this is from This Is Money on 23rd of March, and this one is building upon a recent ALA survey that showed that they predict a 37% drop in the income and in the business of managing agents nationwide, simply because the number of landlords planning to sell up is set to double since the Article 24 regulations were introduced. The main thing I'd like to say in regards to both of those is don't panic. If you listen to commentators, they will tell you that the end of the world is coming and sell your portfolios, get out of the business, it's all going to the dogs. I don't think it is. I think there will be a restructuring of the industry. I think there will be a huge move towards the large corporates, towards institutional investors, leaving smaller investors and the smaller managing agents behind. That obviously we don't want to happen. So this is where I started in coming up with the Nelson Home Investments offering. Okay, if I can give you the changes in a nutshell, these are the most important changes that I can see. The first one is actually quite good news. It's the increase in rent-a-room allowance. Essentially, what the rent-a-room allowance is people who take on tenants, lodges, if you like, they can write off a certain amount of the rental income that they get from that lodger before they start paying tax. That amount of income has increased to £7,500, which is good news for people with lodges. For landlords and managing agents who rely on the housing associations for their tenants, this next one isn't so great. This is basically LHA rents have been frozen. There hasn't been an end date put on this. I can't see it going on indefinitely, but at the moment they are staying static for the foreseeable future, which is not great news. It's not awful news, but it's not good. The wear and tear allowance was a piece of another allowance that basically meant that landlords could write off 10% of their rental income on the assumption that 10% was used for wear and tear, refurbs, that kind of thing. That now has to be accounted for and fully with receipts, all the other accoutrements of full accounting. So that hopefully that is just a change in accounting practices rather than anything else, but it could have an effect. Increase in dividend tax is another thing. Basically, dividend tax, the rate of it depends upon whether you're a low rate or high rate taxpayer. But this was introduced and seen as a disincentive for individual landlords to incorporate themselves. Essentially, it means that if they incorporated themselves and paid themselves purely through dividends, they will still be paying an increased level of tax. Final thing is corporation tax. Corporation tax reduction seems to work in conflict with the dividend tax. It doesn't, not really, but one can see why that's happening, because with Brexit, the UK needs to become attractive to foreign companies for their investment. Best way of doing that is to reduce corporation tax, and the latest view says that probably will go down to 17% by 2020, which is good news for existing companies. And the final two is stamp duty increases and the reduction of income tax relief on interest, and that's the dreaded Section 24. Okay, so the stamp duty changes, relatively simple. Basically, there is a rise of 3% in stamp duty on the purchase of a second home or investment property. The barb in the tail of this one is that this 3% starts from zero. So whereas before you had a £125,000 allowance before you started paying stamp duty, now it starts from zero, and then after that you basically just add 3% of stamp duty onto what you were paying before. So the best way of looking at that is an example. If you buy a house for £145,000, before 2016, the stamp duty you paid was £400. That was 0% on the first 125, and then 2% on the remaining 20,000. Now you've got to pay 3% on the first 125,000, and then another 5% on the remaining 20,000. Your stamp duty due is £4,750. So that's quite a significant increase. It can be argued over the life of a property it's not a huge deal, but for landlords who are trying to purchase either first properties or their next property to increase their portfolio, it can be quite significant. Okay, another biggie. This is income tax relief on mortgage interest. As the situation at the moment is that all mortgage interest that is paid on an investment property can be offset against rental income for tax purposes. This is where the leverage comes in and all the benefits of property. So all of that can be. So a good example would be if you've got £10,000 rental income coming in and you're paying £7,500 of that in mortgage interest, then you only get taxed on that £2,500. From April this year, which at the time of recording is in a week's time, mortgage interest will not be able to be offset at all, but will attract a flat 20% rebate. I do say at all. That is a little white lie. From this April, it'll be 25% of mortgage interest will not be able to be offset. That will be scaled up by 25% a year until it's fully implemented in April 2021, when there'll be no mortgage interest at all that can be offset. Okay, best way of seeing this is an example. Let's say a landlord has a single let property. The rent that is being collected is £850 a month. The costs that the landlord incurs are £200 a month, so that'll include things like letting agents' fees. The mortgage interest is £425 a month, so his actual income is going to be £225 a month. So that's the income that the Inland Revenue will treat, that will be liable for tax. So that's on the basis of that. So we can see there that on those numbers, he'll get taxed 90%, and his net income will be 135. If you can see in the yellow box, in 2017-18, then the difference is there. If you can see, the costs have gone down. The reason why the costs have gone down is because he can only offset 75% of his mortgage. In fact, £106.25. He can only offset that against his income. So essentially the costs have gone down, so therefore his taxable income has gone up. He gets 20% relief on the £106 mortgage interest, which accounts to £21.25 a month. So therefore his taxable income, rather than the 225, is now treated as 310. This is on the same figures, the same income, same cost to the landlord, but his taxable income will have risen from 225 to 310. Tax he pays on there is 124, so his net income has gone down from 135 to 101. If we trace that down, you can see it slowly dwindling away until in April 2021 he can only write off those £200 costs, and that's, he can't write off any of the mortgage apart from 20% of the mortgage interest, which is at £85 that you can see there. So they treat his taxable income as 565, which is £340 higher than his taxable income is now, on the same basis, on the same figures. The total tax he pays is 226, which is actually more than the income he gets. So he's actually losing money month by month on that property, and that's the big worry, and that's why those headlines are saying that a lot of landlords are going to sell up, because as soon as that happens, you get into the realms of negative return on investment and negative cash flow, which, as everyone knows, is fatal to businesses in the longer term. Okay, big important note though, if you're a lower rate taxpayer, and this is an important point, the tax changes don't take you into the higher rate tax band. Obviously, because your taxable income is going to increase, you could go into the higher rate tax band. But if you don't, and you stay in the low rate tax band, the net effect will be zero. Simply because you're going to lose your interest deduction on the 20% tax rate. But that's fine, because that's made up by the 20% rebate that you'll get on the mortgage interest. So the net effect is nothing. So if you are a low rate taxpayer, then there's no need to worry about these changes at all. For the majority of landlords who are in higher rate taxpayer, they are going to have to change. They've got three options, essentially. The first one is to absorb the changes. Just accept these changes and change their strategy. So, for example, landlords who are working, who have a good income, they are simply using property as a pension nest egg. They can change their strategy into a purely capital appreciation model. If they can afford to take that loss every month, there's no issue. There isn't a problem with that. I think that's probably going to be finite, to be honest, because if they're in negative cash flow, and also if they've got negative return on investment, that is going to be bad business, and most landlords will see that and move their assets into some other vehicle, such as the stock market or gold and silver. The next option, and this is the one that the industry is worried about, is a lot of landlords will just sell their portfolios. They will exit the market, looking at the fact they're going to be getting negative return on investment, and will sell up and move their money into some other vehicle. Um, there are several downsides to this. Obviously, the first one is that they've lost an appreciating asset. As soon as it's sold, it's gone. But the second big downside that I can see is as soon as they get into that position, they will be seen by the market as motivated or distressed vendors, and usually motivated or distressed vendors will attract higher and higher discounts. So they get those discounts demanded on their properties. Plus, obviously, with the stamp duty changes, the people who they like to sell to, i.e. the institutional investors or other investors, will be looking for larger discounts on the property as well. That discount could be up to 25-30%, obviously, which isn't optimal, and it means essentially that it will be a zero-sum transaction. The final option, which is the one that I started off on the base point, sounds like a little bit of a pipe dream, but hopefully I'll demonstrate to you it's not, is to adapt the investment style and change the investment model to basically get the three things: retaining cash flow, retaining the benefits from capital appreciation, and preserving return on investment. If those three can be attained, then I think we're on to a winner. Okay, so this is our winner. We've called it a 60-40 plan. It is called that for one very simple reason. It essentially, you sell your property to Nelson Home Investments for 60% of its market value. So putting the property into an existing corporate structure, and then you get 60% of all profits from rental income, refinance and sale for the life. So it's called 60-40 because you get 60 out for putting 40 in, we get 40 out for putting 60 in. So that's the reason for the name. If we can go back to that example that we had before, that property that was attracting £850 a month rent, we've got costs of £200, we've got mortgage interest of 425, and actual income of 225 on that one. This is the way the figures differ. Without the 60-40 plan, we've got back to that negative net income with the higher tax bill. With the 60-40 plan, because it's within the corporate structure, we stick with the income at 850, costs are still at 625. Taxable income is 60% of the 225 cash flow that we had before, so that's £135. Tax is therefore £54, assuming a high rate taxpayer, and net income is £81, which is not as good as it has been, but having said that, it is still a lot better than any other investment vehicle. Okay, so if we just go through the advantages and disadvantages, the advantages are that the landlord keeps the benefits of positive cash flow, so stays on the right side of the accounting. Minimise tax liabilities in several ways actually. The first way is obviously because the rental income is in cash flow at 60%, then the income tax will be lower on that. Also, because of the fact that they're transferring their property into the company structure for 60% of its market value, then there'll be no capital gains tax. I don't know what the capital gains tax impact will be if they sell the property to another investor, but because it will be the sale of a second home or an asset, then they will be liable for capital gains tax if they just choose to exit the market. This way they don't pay the capital gains tax, or minimise that at least. They keep the benefits of capital appreciation, so any refinancing that is done, any sale, obviously that's 60% of that, and also property management and administration are taken care of. That will become the responsibility of the company, of Nelson Home Investments. The landlords are contractually protected. They don't become shareholders in the company. In that way, you minimise and avoid dividend tax. What you do get is a joint venture contract, which legally entitles you to 60% of all of the profits from that particular property. Then that becomes essentially a cost to the business, and therefore not liable for tax either to the business or to yourselves. So that is, and you're protected by that. We've run that by our solicitors. It's a watertight joint venture contract, so you are protected in every way with that one. A bonus for the tenants and also for the managing agents is that we try and keep those keep the flow of that constant, so the tenants won't notice a difference. They still have the managing agent's contact details. The managing agent will still keep the property on their books. They'll still receive the income from it. The only thing that should change is the name on the piece of paper at the agents that tells them where to pay the income, and that should be it. And the final thing, which is actually quite a large one for people in property investment for investment, is that the return on investment is the same as before the change. We designed this purposely so that the return on investment is the same. To go over that quickly, at the moment, for 90% of landlords, the return on investment is 4 to 1. Essentially, they've taken out a 75% loan-to-value mortgage to buy a property to get 100% of the return. So they've invested that 25% deposit to get that 100%. So that return on investment is 4 to 1. With the 60-40 plan, they've sold the property for 60% of its market value. They've paid off that 75%. This is assuming the property hasn't gone up in value. So they've paid off the 75%. So they've invested 15%. And they get 60% of the return. Again, that's a 4 to 1 return on investment. So it's a solid investment, and one where the figures stack up to people who are just looking at the numbers rather than the actual property itself. Disadvantages is that the landlord no longer owns the property, more owns an investment or share in that property. That, to the majority of people, I don't think will be a problem, but it could be a problem to those landlords who do like to deal with things themselves. I personally think that's going to be quite a boon to especially your accidental landlords who really don't want to do that much with the property. So that could be an advantage or disadvantage depending on how you look at it. Again, same thing is your viewpoint, that property management is a responsibility of the company, not of the landlord. So again, that could be seen either way. And the final thing is that decisions regarding the property must be shared now between the company and the vendor. And if the landlord's happy with that, then there shouldn't be any problems with that either. Again, decisions are made purely on the financials for that property, so the decisions shouldn't be any different to what the way they were before. If I can show you and finish up with a graph. This is a basic return on investment graph. The red line shows what will happen to returns on investment if nothing is done. As you can see, return on investment starts falling off fairly sharply as of April this year, until it gets to the 2021 tax year, at which point it levels off at a negative return on investment. We predict that landlords will start leaving the market towards the end of 2017. This is when many landlords and many businessmen actually start talking to their accountants, and once they do that, they'll start seeing their tax bill is going to be a lot higher in the following April. So this is the time, I think, when the impact will start coming through. It's also the time that I would imagine that landlords are going to start banging on the doors of their agents and of their accountants, asking why they weren't told about this and how they didn't know. So that's the time when we need to start worrying about businesses. The purple line, conversely, is what will happen on return on investments if landlords go with the 60-40 plan. Essentially, nothing changes. Return on investment stays the same. I would actually say that's probably quite conservative. As property prices rise, and commentators have said they are due to rise quite significantly in the next few years, as the property prices rise, then that return on investment should and will go up. So yeah, that's quite a nice way of looking at that. And that's all we've got to go with on the tonight. So I just want to say thank you for coming and thank you for watching this webinar. As I say, my name is Chris Nelson. There's the website. Please contact me on my email address there or on the phone number. If you've got any questions, I'd be more than happy to answer them for you. It doesn't have to be about the 60/40 plan. It could be about the Article 24 changes. But either way, please get in touch. I'd be more than happy to answer anything. You can leave a message on the website, and we'll get back to you on that. So thanks very much for coming, and I look forward to hearing from you.